Okay, guys, Brian Stevens here with the National Real Estate Post. I have Dave Stevens, and this is kind of what we were talking about yesterday. It's the new issuer eligibility standards that Ginnie just came out with a couple of weeks ago, late on a Friday. Dave Stevens sent me an article on this yesterday, and I got to tell you, I've been looking at this for the last day and a half. I'm still kind of in the weeds on it. It's very difficult to understand, so I know that a lot of our viewers are going to have a hard time understanding what we're talking about here. So if we can keep that in mind. And then I think it's really important to explain why this could be catastrophic, at least based on some of the conversations I've had for the mortgage industry. So can you just give us an overview for starters, what the new issuer eligibility standards with Ginnie is?
Yeah, so we know that Ginnie had been working on a new revised capital rule for their issuers. And I'm sure that the team at Ginnie is well aware that FHFA was looking at the same for their approved sellers to the GSEs. And we know that FHFA recently hired some folks on the staff, or is in the process of hiring, I think, 3 people to look at the non-bank market in specific. This rule, to your point, came out late in the afternoon on a Friday a couple of weeks ago. Really caught the industry off step, because I don't know how many people even recognize that it had come out, thanks to Chris Whalen for coming out. But in short, it attaches risk weightings to what we do as originators, risk weighting for agency business, for Ginnie business, and more. But the dagger in the heart of the FHA program is that it attaches a 250% risk weighting on Ginnie Mae MSRs, mortgage servicing rights. Yeah. And that's just outrageous, frankly. It would add extraordinary cost to loans, because suddenly, and particularly for the non-bank sector, because as we all know, non-banks live and die on their core capital that they have, which is substantial, and then lines of credit that are used in various forms, such as warehouse lines. To suddenly have to increase for any service retained Ginnie Mae MSR, to suddenly have to apply 250% risk weighting to that. And there's a formula in the Whalen piece, which is good to look at, but it tells you that in the end of the day, your risk-based capital requirement under this Ginnie Mae standard would go up significantly, solely because of the risk weighting on the MSR. That would mean you have to hold a lot more capital against those servicing rights, thus devaluing that servicing asset, which, as we all know, Ginnie servicing values are a big driver in the ultimate rate that you get through an FHA program.
Right.
And frankly, I'm not sure what would happen in the non-bank space in terms of their ability to provide an effective rate coming from the FHA program. Let's keep in mind, guys, right now, if you're about a 720 FICO or above, as you all know, agency execution is better than FHA, right? If you get below 720, once you, with a low down payment, with a 5% or less down payment, once you add on LLPAs and mortgage insurance and more, FHA actually is typically best execution. But now this will move that dial way down. It'll move the FICO band down, because the cost of the FHA loan across the board would go up. I actually think for some existing servicers, some smaller IMBs that are retaining servicing, it might force them to get out of the business altogether. It's just an intense amount of capital that you have to hold for an asset that as we all know, is government guaranteed. If you can bear with me for 1 second, I reached out to an extraordinary capital markets technician who used to be the chief risk officer at FHA, amongst senior roles at the GSEs and elsewhere. But I asked him to review it, and he came back with the new risk-based requirement, quote, "The new risk-based requirement that includes the MSR charge seems excessive. Ginnie Mae should have supported their proposal with relevant data and greater transparency, given the large increase in the requirements." This goes to your question, Brian, is who advised them.
Okay.
I have a sense of who advised them, but I don't want to name names. But they would have been under a contract with Ginnie Mae that they and a company they lean on a lot. So that's as far as I'm going to go on naming the company. But
Got it.
if Ginnie is worried, just to go on, if Ginnie is worried about stress events, they can review the adequacy of the net worth and liquidity requirements and increase those if necessary. And then he said to me, I do agree, as currently proposed, the requirements will have a substantial negative impact on low mod and minority borrowers. My view, this puts a dagger, if it's allowed to go through, it'll put a dagger in the FHA program. And think of who's in the FHA program.
Right.
80% of purchase transactions are first-time home buyers. Roughly two-thirds of all minority purchase borrowers get their loan through FHA. So we're talking about almost a direct attack on the folks at the Biden administration, and Secretary Marcia Fudge of HUD is trying to states that they're trying to protect.
Right.
So how this rule got out, and frankly, the need for an aggressive response from industry, to me, seems paramount. To find out how it came out, why the methodology is not explained, why the over excessive treatment of MSRs in terms of a risk weighting is included in this proposed rule. Why did they introduce it in the dark of night on a Friday afternoon when nobody saw it? Why was there not a press release? Why didn't they get HUD's approval, knowing that this would have a significant impact on the market? Shouldn't HUD have been involved? Where's OMB and a group called OIRA, which is supposed to evaluate proposed rules for overall impact to market and slow things down if it's going to have a larger impact? A lot of questions to be asked. And
well, I mean, it does seem quite intentional. I've heard the same things that you have, and now we have a comment week through the first week in August, which seems, coming off a lockdown with COVID and people trying to, kind of find their bearings right now. It seems like this is a bit rushed. Do you think it is intentional? Is there?
I believe it's intentional, and I think this is going on around the building. There's, Chris Whalen points to a career staff guy named Greg Keith there. I've sent an email today to the person who ultimately he reports to, and I'm not blaming Greg. I don't know if I doubt he's solely responsible for this, but I am seeing this around HUD, at FHA and elsewhere, where the career staff is taking action on things that the political leadership is unaware of. There's an agenda, a HUD priority agenda, and on there is a down payment assistance focus, which is a residual carryover from the Brian Montgomery regime in the last administration. And I am certain that Secretary Fudge had no idea that was even on her agenda, which it now is on. She testified yesterday in front of House Financial Services and was grilled pretty aggressively on this one point by Heisinger, a member of the committee, and asking about this. She seemed to not know anything about this on the agenda. So this goes around this whole gamut of we have a lot of empty seats at HUD. And so, who's running the hen house here? And I think that right now, it's the proverbial wolves in the hen house, or fox in the hen house, that we have to be concerned about. This was career staff. We don't have a president at Ginnie Mae. As you know, we haven't had a president Ginnie Mae for a long time, going back to even through the previous administration. Is
that even possible?
And we don't have an FHA commissioner. Julia Gordon has been nominated, but we haven't even heard if she's when the hearing's going to be set. And there's some attacks on her that came out because of potentially deleted tweets that were negative to Republicans. So that may cause a problem. We do have a deputy assistant secretary of single family at HUD, Julian Joseph, who actually comes from MBA, Mortgage Bankers Association. And I'm hoping the secretary will start leaning on her. But my view is rules like this that get out are extremely dangerous. I think there was an obligation for public notice, not just to stick it in the Federal Register as a proposed rule and be silent about it on a Friday evening. I think there's a responsibility to be transparent and provide the research and data that would support a 250% risk weighting on an MSR that's guaranteed by the federal government with explicit backing. So, that's it. Brian, the one thing I would just add to this is, and I would expect hopefully your audience gets outraged, and that you should go to your state trade associations. If you're a broker, you should get NAM or AIM or whoever's you work with involved. Brokers, bankers, you should get all the state MBAs involved and MBA in Washington. I read an email from someone. Well, I'm not going to go down this path, but I do know that the MBA obviously is going to issue a comment letter to the rule. That's fine. We need more than a comment letter right now. We need people, sending letters to their members of Congress, to Secretary Fudge. This rule has to be shuttered. I'll just state one final point. Chris Whalen may have understated the point that there's no risk in Ginnie MSRs. There's some risk. There's risk if there's an event. Where will the liquidity come from to do advances to investors? Something we've all worried about.
Right.
In the event there's a huge, market correction. So we get that. We know there's a concern about that. To do this right now, when there really isn't a concern of a severe market correction, and to make it so extraordinary without showing the analysis is problematic. And that's why that comment I read to you a moment ago from the former chief risk officer is right. I mean, they have an obligation to be transparent. It's not that there's no risk from Ginnie MSRs. 250%? Hell no. That's just extraordinary.
And I want to read to you so our viewers kind of understand this. Some of the notes I took in a conversation with Chris. He said and again, these are all possibilities. They're not certainties, but they are possibilities. Small to mid-sized mortgage banks that retain servicing, it would basically turn them into brokers for JP Morgan Chase, is what he said.
And just to explain that, Brian, the large mega banks have multiple and extensive access to capital. Capital is not a concern for the banking system, and they are rated, and so they can borrow money cheaper than an independent mortgage banker can by leaps and bounds. And so the problem is, in this case, this would really crush independent mortgage bankers, and to your point, best execution and safety and soundness for their own companies would force them back into the business of selling to a servicing lender through either a correspondent channel or, to Chris's point, become brokers. Either way, a lot of people do that, but you don't want that to have your sole dependency. And frankly, it'd be terrible for our business because it would take out a lot of the competition that exists today,
right,
where all of you, and whether you work for a mortgage banker or you work for a broker, you have lots of options of where to put your loans. And as a mortgage banker, you have lots of options to where to put your loans, but you don't necessarily, you also have lots of options around where the servicing gets done for those loans. This would totally upset the dynamic. I think it's intentional. I think some of the senior staff at Ginnie who have been there and are part of this rule believes that IMBs are a risk to their portfolio, and frankly, some would like to force a shift, and I think that's what's happening here. By the way, it's unfounded as well. Without independent mortgage bankers, there would be no FHA right now. Banks are not rushing back into the doors. It's non-banks that are doing the vast majority of the lending for the FHA program, and thus the vast majority of the servicing rights are coming from non-banks. And you stop that by doing this rule. All you're going to do is tighten credit and increase rates.
So do we think that if Marcia Fudge, who seems like everything I've read about her, she seems like a really decent person. I mean, do you think maybe she doesn't if she didn't understand what was going on, do we have an expectation that once she learns what's going on, she might roll this whole thing back? I mean,
I think she could. Yeah, and look, we didn't know what was going on here, so and we're in the industry, and I think for all your viewers right now, they're just finding out about this today. So,
Yeah.
I think we were caught a little asleep at the switch because they snuck it around our backs as an industry, which by the way I'll call foul on all day long. But I do believe, I'm hoping that once the secretary is informed about this and is advised by her senior staff, folks who I know who have come in, even though there aren't a lot of them, I hope she orders Ginnie to scuttle this proposed rule for further consideration. And that can be done. It's complicated now that it's actually been posted for comment. But I think there are multiple ways you could do it. And you could do it through OIRA, or I think the secretary alone could demand it. I'm hoping that'll be the case. I'm certain that she is going to be informed. And I encourage anybody who's, got a pen to make sure that they address their concerns to HUD directly, to the secretary's office, and anybody they can get access to. That's my new puppy, by the way. I used to have a small puppy named Chloe who was in the background, and she didn't bark as much, and she was very old, but over COVID, I lost her, and we now have a new puppy, which is a lot more vocal.
My next dog is going to be made out of porcelain, and it's going to have wheels on it, and I will drag that across my floors and pet my porcelain dog wherever I go.
Because, there you go.
Seriously, they say man's best friend. If my best friend ever went and used the bathroom in my backyard, he would no longer be my best friend. My God, man.
There you go.
Dave, hey, listen. So for the viewers who are watching this, I'm going to post a couple of things that Dave wrote down below or somewhere in this area. But for our viewers who are watching this, what is the call to action for them? Should they be writing their senators on this, their Congress people?
Yes. They should say they should write on behalf of the industry, on behalf of home ownership, on behalf of minority home ownership. I'm writing because Ginnie Mae has put out a proposed rule that will put a dagger straight in the back of the FHA program, which is so important for first-time home buyers in my community, and particularly minority home buyers. And this rule has no logic to it. It's not transparent. It was done in the dark of night, and I'm asking your help. As a business person or a business owner or whatever your role is, where I help people get into homes in my community, and on behalf of everybody who works in my industry, I'm writing this to you. Something along those lines. But the dagger in the heart to the FHA program and a direct attack on first-time home ownership and minority home buyers at a time when we have an administration calling to focus on expanding those opportunities. This moves the dial back, even back before the last administration and beyond.
And guys, by the way, just understand that this not only hurts the clients that you're trying to serve, but if you can't serve them, it's also hurting your business. It's hurting your personal business. Most of my viewers are working for non-banks. This is going to put enormous amount of pressure on companies, some of which may not even make it through this. And the cost and the ability to go ahead and write and fund an FHA deal would just get destroyed. I mean, this thing is ill-conceived based on everything I've heard from people who understand this more than I do. So we definitely have to have a call to action here. Everybody in your company needs to go ahead, put together a form letter, and let's all go reach out to our Congress people and see if we can do something about this. Dave, thank you so much for bringing this to light. Yeah,
you bet, Brian. And the last thing I'll tell you, I run a consulting business. I only have non-bank clients, but I reached out to a whole bunch of other non-bank CEOs, and the alarm was incredible. The reality to me was, how dare Ginnie Mae issue something that's so dramatic and negative to the industry, and particularly companies that these people have, as you know, non-banks, the owners are usually the ones who built them from a broker using blood, sweat, and tears. They didn't walk into a shareholder-owned, huge monolithic bank. These guys literally had an attack on them, and the attack is right now in a comment period of 45 days, which is a short comment, by the way, period. The alarm bells went off with everybody I spoke to today. So I guarantee you, if your CEO does not know about it, You need to make them aware of it. Use the Chris Whalen piece. Hopefully you'll include that link.
Yep.
And if they are aware of it, I am suggesting, and I've suggested to a whole bunch of CEOs today, that we need to go beyond just submitting a comment letter, which we should do. We need to hit the alarm buttons, get press talking about it. If you have media access, get newspapers talking about it. We have a guy from our business who writes for the Orange County Register. Get him to write on it. While we've been here, I've had a call from Kate Berry from American Banker. I know she wants to talk about the story. Use whatever relationships you have. Let's kill this thing quick, and then we can celebrate it. Have another show where we're talking about, look how effective you can be when you rally the troops.
So that's a good point. And the level of outrage that I'm hearing on this is something that's kind of unfounded, and kind of looking at the mortgage space for 15 years. The amount of alarm that's taking place right now is really remarkable. And I hope that our viewers...
and I know you want to stop this, but if you read the Chris Whalen piece that you're going to see, if you read the opening, he talks about how damaging Mark Calabria is, and now they're rolling back to 50 basis points. And I thought the enemies had left the building, and here we have a career staff person who didn't even clear this with the senior executives at HUD, posted a rule that is just would be a crushing blow to our business. So we got to take it seriously, and we got to push back hard.
Well, Dave, thank you so much. I absolutely appreciate this once again for bringing this to light for folks. And then where can people find you at?
Dave at mountainlakeconsulting.com is my email, and I don't have a website, but that's where you can get a hold of me.
Dave, thank you so much. I appreciate it.
You bet, Brian.
All right, thanks. Bye.